Are you trapped in the financial vortex? New rules for wealth building this week on the Extreme Personal Finance Show. All right, I'm excited to welcome back to the show Brian Muller. Brian is a certified financial advisor for over 25 years. He's also a certified life coach and an author. And Brian, welcome back to the show. And first of
Hey,
all,
thanks for having me, man.
yeah, man, first of all, I got to congratulate you on the book launch. How awesome is that?
Thank you so much. Yeah, it was awesome. We put the book out, came out August 6th, and did a big book release party, got the band back together and had a great night. So it's really been fun. It's opened up a lot of doors for me, and I got a PR guy now. I guess I send him a check every month, and he's getting me on. I'll be on WCCO today. I was interviewed this
Saw
morning
that.
talking
That's
about the
great.
Social Security lies. So that'll be on today at 4 o'clock. So pretty exciting. Yeah.
That's awesome. So just share a little bit like about the book and like what people can expect reading the book.
Yeah. It's everything I've learned about health, wealth, and life all in one book. I'm a certified life and health coach as well as an advisor. And I think what I've seen over the years with clients that have built up an enormous amount of wealth is there, a lot of them aren't healthy enough to really enjoy it. I've had instances where clients, retire and 3 years later, one of them gets sick. And it's really just a book about how can you live this richer life? And it's not just about money. It's about having the health and vitality to really be able to enjoy your life. But also like there's some life coaching stuff in there too, like how to have better relationships with your spouse and your kids. It's just kind of a handbook for life. And there's an action plan and a 7 steps chapter to help people kind of plan life out, like live life by design rather than by default. It'll help you get a better mindset around money, around health. It'll help you, transform into somebody that you probably won't recognize in a couple of years by creating new standards in your life. And so I'm very proud of it. And if I never put out another book, I am working on another one right now. But if I
All
never
right.
put out another book, I'm very proud of it. So
That's awesome. Well, good for you. Again, congratulations on the book. Um, but one thing that I wanted us to talk about, you know, I was listening to your podcast and just really quickly, so your podcast, Wealth Decisions, is that correct?
yeah, Wealth Decisions by Brian is what it's called. The full title.
Right on, right on. So I was listening to your podcast, and it was interesting because many of us, right, we're grown up. Like once we get our grown up job, we're told, okay, save 15% of what you make, invest that into index funds, and just don't touch it, right? But now, housing, healthcare, childcare, those costs have just exploded. And you mentioned
Right,
something, the salaries really haven't been keeping up. So like the
right.
old the old playbook that we know really doesn't work anymore. So you kind of talked about these three things that kind of come together in what you mentioned as the financial vortex. And I want you to share a little bit about what this is and most importantly, what we can do about it.
Right. Yeah. When you look at like our parents, they probably bought a home and the mortgage was 20% or 25% of their income. And they probably put 20% down. A lot of people can't put 20% down. So healthcare costs have gone up, quite a bit. Childcare costs are up a ton. And so we're trapped in this vortex where when we have an emergency, we can't save as much as we'd like to because we're tapped out. Most people have their mortgage is 45, in some cases 50% of their take-home pay, which is way above what any financial advisor recommends. They say 28% is where it should be. So there's no room. So you have to figure out a new formula, and that's what that episode was about: the new retirement formula. Save smarter, invest better, and keep more. And uh, you have to start with looking at your lifestyle. Obviously, a lot of these folks, they're not really living above their means. They're trapped in this vortex. If they have a problem or an emergency, they're they're putting it on a credit card, and then next thing you know, the credit card's building and building, and then they're always paying off their credit card and never getting back on track to save for retirement. So when you have salaries that have barely budged compared to all these costs, you have an issue here where people don't have 15, 20% to save. So you got to save smarter, you got to invest better, and you have to figure out how to keep more of your take home pay. And that's what the Financial Vortex has created for people. And there is a formula to get out of that and get on track to be able to catch up with retirement savings if you feel like you're behind, and make sure you stay out of debt.
Yeah, I was really shocked. One of the stats that Goldman Sachs had mentioned, by the year 2033, 55% of people under 50 are going to be living paycheck to paycheck.
Yeah. Yeah, and it's really high right now. People feel like they're living paycheck to paycheck, and some people are living above their means, but really it's not anyone's fault. Um, we have inflation that doesn't feel like 3%. The Fed, wants it to be at 2.5 to 3%, but we know that's not the real inflation rate. I'm actually working on an episode right now called "The Inflation Lie," and it's not. It's 40%. Based upon all the different things we spend money on. When you really look at what inflation means to us, it's almost unsustainable. And you go out. I don't know if you've been out recently, but I went out to a concert and I paid $35 for a vodka and soda. I'm like, all right.
It's
Next time I'm
ridiculous.
drinking at home.
I know, that's absolutely
I'm
ridiculous.
just, yeah.
So
When is
what
that
are
going to stop? What is it going to be like? Where the
right?
point where people are like, I'm, I'm not paying that.
Yeah. Well, and it's across the board too. I mean, it's even like, I think may have talked about this earlier. I mean, insurance too. I mean, just in addition to your
Right.
housing expenses, but if once you add homeowners insurance and taxes, and it really starts to be out of reach. It's out of control.
Yeah. Yeah. And so what can we do about it? I just had two clients. They got quotes from different insurance companies for their homeowners insurance and their car. And that's your big win. And I know we'll probably get into that a little bit more in the episode, but your big win is reducing those costs. It's not skipping buying lattes, which, yes, that is expensive too if you add it up every day.
Hmm.
But the big wins are going to be the things that can allow you to have room in your budget to start saving more. And a big win would be insurance. You can save. My client saved about $1,200 a year just by getting some quotes. I had another client that reduced his insurance costs by 4,000. So, but he has a lot of other properties and things like that. So, a lot of us kind of buy insurance and we set it and forget it, right? We think we got the best deal and we let it go. But that's a quick win right there is get 3 quotes from different insurance companies and redirect that money that you save into saving in a taxable investment account or a Roth IRA or something like that.
Yeah, that's great. So let's continue with that. What are some of the things to say that people can do to save smarter, right? Some of those other guaranteed wins. What are some other things you would recommend people do?
Yeah, I think, the biggest guaranteed win for saving smarter is make sure you get your match. Like if you have a 401k that has a match, I run across a lot of people. I ask them, are you maxing out your 401k? And a lot of people think maxing it out is going up to the match. Some people are not even putting enough money in their 401k to get the match. They're leaving free money on the table
I
every single year. And most 401ks, most companies will match up to 50% to the first 6% that you contribute. So if you contribute 6%, you'll get 3%. But some people are not even doing that. They're leaving that free money on the table. But also, if you can save more than that 6%, you have to figure out a way to do that. And don't just go from 6% to 15%. That's going to be tough at first. Increase it by 1%, every 6 months or every year. And by the time you do that every single year, next thing you know, you're getting closer and closer to the match. And you don't miss 1%. You'll miss 10%.
right, right.
And obviously, if you can do 10%, do that.
Yeah. And you might want to even talk to your employer. Sometimes they may be able to do like an automated where it just automatically increases 1% every year. And that's like, if it's automated, it's even better because then you, you don't have to worry about it. So,
Yeah, and that's the second smart move is automate it before you see it.
okay,
You
perfect.
gotta wealthy people, yeah, wealthy people, they don't budget, they allocate. They have
Mm,
the money comes in and it gets allocated places. And if it's in your checking account, if money's visible, it's spendable.
right.
We know this. It's psychology. If it's there, you're going to spend it. And the solution is to get it out of your checking account, away from your bank, somewhere in a brokerage account, a place that you can't get easy access to, and automate, 5% to go into a taxable investment account or a Roth IRA. If you automate it, that's your system. That's what wealthy people do is they allocate. They don't budget, they allocate.
Dude, I love that. I'm gonna put that on a t-shirt. That's pretty good. I'll give you I'll give you credit, but I'm gonna put that on a t-shirt. So, and that's I really do like that. Like I've done that with like my emergency fund, right? That's in a separate bank. Money goes into the emergency fund. I never see it. When I look at my balances or I'm, doing something, I never really see it. And that's kind of the best way that works for me. So you're absolutely right.
Right. Yeah. Yeah, you gotta automate that. And I think the third smart move is to, get a financial plan, get a personalized plan. People that have a personalized plan have, I think, a 27% higher savings and income ratio. So when you have a plan and you start like really following your net worth and building your wealth, you have a much better chance of, really being on track and getting on track if you're off track. So create a financial plan, even if it's just a simple one. If you work with a financial advisor, they can help you create a comprehensive plan. But there's a lot of great resources out there that help you create a financial plan. And a financial plan is not an Excel spreadsheet. Uh, yes, that's fine, but that doesn't factor in inflation and taxes. I had a client come in and show me his Excel spreadsheet he was super proud about. And he said, well, I figure I can take out this much money when I retire. And I said, well, you got to factor in taxes and inflation in your financial plan. It can't be just a spreadsheet. So there's some great financial planning tools out there that are, very reasonable to work with, that just make sure that they have those types of things to factor in inflation and taxes, which are the two biggest wealth killers out there.
Sure, absolutely. Absolutely. So there were kind of three main tools that you talk about in your podcast. So we just talked about save smarter, and then you talked about ways that you can bet better. Talk a little bit about what that means and how people can do that.
Yeah. So there's a lot of people out there doing some type of side hustles.
Hmm.
The bet better or invest better segment is just like, number one is think about some strategic side income. There's a lot of things you can do. You don't have to go DoorDash, but you could do something in your field. You could consult. You could do whatever matches your skills. Just $200 a month that you could make on a side hustle invested from 30 to 65 at a 7% annual returns, like 325,000. So um, it doesn't have to be like something that takes up a ton of your time. And the other way is just some type of passive income that actually works. Rent unused assets. If you have a parking spot you don't use, rent it out on Spot Hero. If you have a spare room in your house, I think you did some house hacking at one
Hmm.
point in your life, didn't you?
Hmm.
Yeah. So, rent out a room, use that passive income from a, 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 a room that's rented and invest that for the future. And the big thing out there now is like digital products. Even if you have any creativity, you can create digital products that can bring in $200 to $500 a month. Anything you can do to bring in some type of, side income
Hmm.
without taking a ton of your time and invest that for the future, that's gonna help you immensely build wealth and get back on track if you're behind.
That's awesome. Yeah. And again, you can go visit my blog at heavymetal.money, and I got tons of articles on different side hustles, different ways that you can earn passive income. A lot of them I've tried, and some of them worked and worked well. I mean, I've done everything from, I run an Amazon store. I sell products on Amazon, both from a wholesale perspective and also online and retail arbitrage. Again, I'm spending an hour or two a day, but you can earn $500 a month, $1,000 a month. It all depends on, how much time you want to put in and what kind of products you're
Yeah,
getting.
that's
But
awesome.
that's a good side hustle for me. And you mentioned
That's
renting
awesome.
spots out. Yeah. I actually used Neighbor. Like once my kids were gone, I have a 3-car garage. I actually used the Neighbor app to rent the third stall in my garage. So someone just stored their boat there during the night,
Nice.
right? So
You're the ultimate hacker, man. That's awesome.
and that's the thing. I
Yeah.
could talk about so many
That's,
side hustles.
I mean,
Get this. I did one called
yeah,
Rapify. This was right before COVID. So I was driving every day for work, right? I would drive to when I had my W-2, I would drive to customers' sites throughout the cities. I used a company called Rapify. They would wrap my truck in an ad, right? Vinyl wrap. It just so happened mine was Zoom,
nice.
right? The meeting platform. And literally, as I'm driving, they give you a little GPS puck you put in your vehicle. You run the app on your phone, and it tracks where you are and the time of day. I know. And then so basically, at the end of the day, you would look and see, oh, I earned $36 that day, and it all adds up. And I had to go right into my brokerage account, and it was an awesome side hustle. It didn't. It was totally passive. It didn't have to do anything.
Yeah, that's the ultimate passive income, right? Is passive income you don't have to spend any time on. That's huge. That's awesome, man. I'm so like watching you from afar for a couple of years here. It's been really fun and I know it's not just been 2 years you've been doing this. I mean, you've been
That's all right.
working
That's
at
all right.
this for a while, in the fire movement and all the things you're doing. So that's pretty awesome. The third way of bet better investing is just smarter investment allocations. A lot of people, they do the same strategy in all their different accounts. Well, your Roth IRA, for instance, should be in more growth and aggressive growth investments, because that money grows tax free. So put your growth investments, actively managed funds, things like that, or growth or aggressive growth ETFs in your Roth. In your IRA, if you have an IRA and not a 401k, real estate investment trusts, fixed income, actively traded funds. Put those types of investments and put your more conservative investments in your IRA if you're close to retirement. Qualified dividend stocks in your taxable account. Being smart it's not about just asset allocation, it's about asset location. Where are you putting your different types of investments? So being smart with that, Goldman also did some research and said that, modest allocation to private markets, which we now have access to in 401ks, can add 0.5% in excess returns over time. And that doesn't sound like a lot, but over a career, that's 14% higher retirement savings
Right.
just by taking advantage of some of the things that are now available. You have private equity, private credit, now available in 401ks. I think cryptocurrency will eventually be in there,
Right.
like Bitcoin ETFs and things like that. And I do believe you should have, and this is not a recommendation because I can't make recommendations, but you should have probably a 3 to 5% allocation to Bitcoin using like a Bitcoin ETF. It's really, one of these things that it took a long time to be widely accepted, but it is like digital gold and it's not going anywhere. It's going to be around. There's a limited supply. There's a lot of money going there. So having some exposure to crypto, I would avoid all the other coins and all this stuff out there, but having
You mean
some
you mean
exposure to
you don't
Bitcoin
want me to
is good.
invest in the Haktua coin?
I mean, is there one?
There was one, and she
Probably
got
is.
there was like a
Oh
lawsuit,
God.
and it was like a big deal. Anyway, yeah. That you just hit something I wanted to ask you now that I got you on here. Gold hit all-time high, and I want your thoughts on like precious metals and what like percentage of a portfolio should be invested in stuff like gold and silver. What are your thoughts there?
Yeah, it's funny you said I'm actually working on an episode about gold and stocks because I've been doing this for 25 years and I very rarely have seen a period where both gold and stocks are hitting all-time highs at the same time. Now, gold has come down from their highs. But I've never seen that because gold is like an asset where it's more fear driven. People go there when they're fearful, and that hasn't been the case. People have just been going there because they don't want to miss out on it. And you have countries like China who've been buying gold, a ton of gold, more gold than they've ever bought over the last 3 to 5 years. So you have a lot of people wanting gold. They want real assets because I think inflation is going to be a problem again. When we have the government, printing another trillion in debt every 90 days, the only way out of this is to inflate out of it. And they're investing in precious metals themselves. They want to own real assets. They're investing in companies like Intel. I think they took a 10% stake in. I think gold, more so than I ever have, probably should be an allocation in your portfolio. It doesn't have to be just gold. It could be a precious metals ETF, like you were talking about, like a
Mm-hmm.
silver and gold ETF. This isn't a recommendation, but I think having a modest allocation to gold, maybe 5% of a portfolio, makes some sense. But it is at all-time highs. It is a volatile asset. But I think having some gold, if the markets do correct, and they will, gold will probably hold up because it's going up because everybody wants to own it, the fear of missing out. But if the markets go down, the fear gauge will kick in and people will want to buy gold too. But I do think gold probably more so than ever. I've never really recommended gold. It's usually in like some funds, like gold mining companies or something like
Mm-hmm.
that. But I do think that gold should be part of an allocation. But you certainly shouldn't go run out and put 30% of your portfolio in gold. It just um, there's no earnings. There's nothing that support it other than fear and greed, and that's not really a good equation.
Well,
So
like, I've always thought that gold was just that hedge against inflation. It was like, but just recently it's just been so crazy. But anyway, sorry for the tangent there. That was
yeah,
different
no,
conversation.
I mean, it's on a lot of people's minds. So I'm glad you brought
Yeah,
that up.
yeah, that's awesome. Well, back to like that third tool. So we talked about different ways that we can save smarter, different ways, look for market allocation, side hustle stuff, but also how can we keep more of what we earn, right? So what's that next tool there?
Yeah, and keep more, obviously the insurance optimization that we already touched on. Go out and get some quotes for your home and owner's insurance. Those are fixed expenses that can be reduced. Average savings by just getting some quotes is $600 to $1,200 a year, and over 30 years, investing that's a big chunk towards your retirement. You can save 10 to 25% just by increasing your deductible,
Mm,
bundling home and auto and things like that. And a lot of people do that, but they never get another quote from two or three companies. They just stick with their insurance. Another way is to just do a subscription audit. This is not as big. This isn't as big of a win, but I just looked through all my subscriptions and I saved $80 a month by just
really?
some subscriptions I just forgot about that I had. Go through them all on. If you have Apple as your phone, you can go through and you can look at them all right on there and go, well, I'm not using that anymore. So I was able to free up about $80 a month. And that's not a huge one, the subscription audit, but we are wasting money. And if you have a gym membership you don't use, you're not going to the gym, get rid of it. Streaming services maybe that you replaced.
Yep. That's a
Um,
win. That's a
you know,
win.
we're
I take that as a win for sure. And
Yeah, I mean,
man,
like we all got rid of cable.
right. Exactly.
We all get rid of cable to save money. Now our streaming is right back to where cable prices were because we got Netflix, we got, you know, Paramount, we got HBO Max, and we don't need
Exactly.
all those. We shouldn't be watching TV. If you want to get ahead in life, you should be reading books.
That's right. That's right. You know, Also, while you're going through that audit, I recently just did this, and again, it's a little bit, but it all adds up. I did things like I realized that my home internet, my ISP, their prices went up, and I was paying like $110 a month for it was like 1.5 gigabits, right? And I just called them and we're like, can I just go back down to gigabit? Sure, save me $30 a month. And then
Right.
I called
Yeah.
my garbage service. It's like, it's been on the same size container, the same payment every 3 months. I'm like, is there any specials or promotions you have? Oh, sure. Save another $20 a month. Like, if you call and just ask,
Yeah.
you can get like $100 a month. It's crazy.
Yeah. Yeah. And I think the energy thing, like my energy bill in my house is like $500 a month. And I didn't even know about some of the other options you had with your energy stuff, like spreading it out where it's not, so high in the winter. There's ways you can reduce that cost as well. I think it's just coming down to like set up a plan. I kind of had a 5-minute challenge for people just to do 3 of these moves right now. The subscription audit, make sure you're getting your full match, and just spend some time. And then next week, shop your homeowner's insurance and audit some more subscriptions. Maybe calculate a side hustle potential. Look at one skill you could monetize for an extra $200 a month. And then 1 month from now, meet with a financial advisor, set up a financial plan. And one thing I didn't talk about with Keep More is like HSA accounts.
Yeah.
Most people are not doing HSAs. They are, the super secret retirement account because you get triple tax advantage. And when you're 65, you can take money out of it. It's just treated like an IRA basically at that time. So, make sure you look into HSA accounts. They are the best way because you get the tax deduction plus tax-free growth. If you use it for healthcare, it's tax-free. If you're over 65, you can take that money out for any reason. You just have to pay the taxes. Those are the secret retirement account to help you keep more of your hard-earned money.
I love that. And HSAs too. Talk to your employer if they do have one, because you also could get free money. I know when I had my HSA, my employer, part of my family plan, they would put in $1,500 every year. So every January, that was free money I got
That's
contributed to that
huge.
account.
Yeah, that's huge. The one caveat is you have to have a high deductible healthcare plan. You- So, but for most people, unless you have some health issues, that's the better way to go anyway.
So would you think that this financial vortex that people are kind of stuck in, as I was listening to your episode, I was out on my walk, getting my steps in, listening to your episode, and I'm like, is this like the new middle class trap?
Yeah, that's it. I mean, it's something that sucks people in, and it's like a whirlpool, and you can't get out of it unless you start doing some things actively to get out of it. I always used to say, like, if you say this expression is I only make enough, just to get by. Or if you say something like, I just make enough to pay the bills, well, that's what you're going to continue to get. You can figure out a way to get out of this vortex. If you don't, it's just going to keep sucking you further in and you're going to get further and further ahead. If you just take some steps, save money, save smarter, invest better, and keep more, you follow some specific, strategies, you're going to have some wins. And the more wins, small wins you can have, they build and build on top of each other. And next thing you know, you're out of it. Now, obviously, some of us can't move. Like, we're stuck at a house. We can't afford to buy it. Like, I couldn't afford to buy my own house for myself right now. It,
Hmm.
it's gone up so much in
Right.
value, and interest
Right.
rates are so high. But you could move somewhere a little further away. So it might have a longer commute, but you could save costs. Um, some of us are stuck with certain fixed expenses that we can't get out of, like our mortgage or our car payment. But if your car payment is higher than what you're saving for retirement, something needs to change. You're driving around a car way too expensive for your lifestyle just to impress people that don't care.
Right. Right. Exactly.
So there's definitely things there. If you have a car that's more than 8% of your monthly payments, more than 8% of your gross income, you're driving around a car that's too expensive. So that's definitely something that you need to look at. And that's probably a tough one for most people because they're used to driving a certain nice car. They don't want to look like a pauper driving around a Honda Accord from 1992. But
But
If you want to
once
build wealth, you have to be smart.
yeah, and once you start to live without having a car payment, it's really hard to go back to having a car payment.
Yeah, yeah, you know
Um,
that.
yeah, yeah. So I was gonna mention too, you mentioned something about, you know, those little decisions like, don't go buy a latte every day, whatever. And that reminded me of something where, start paying attention to the $13,000, the $30,000 decisions versus the $3 decisions, like the big rocks, right? What are some of those other things that people can do? Because, you and I talked about how the three biggest expenses are like housing, transportation, and food. If you're going to make those big rocks, what are some of those things people can do?
Obviously, with if you're eating out every single day, really easy way to save $200-300 a month is to cook from home, do some meal planning. Don't eat out every single day. That is a huge expense, and it's just gotten higher and higher. I just went and got a salad the other day at some fancy salad place. Like it was $22. I'm like, what am I doing? I can make a salad
Yeah.
at home for like 2 cents.
Right?
But it is pretty darn good because they mix it up really nice with a lot of good fixings. Obviously, that's something that you can do to lower some of your costs. The car hacking, like make sure you're not driving a car that's you know the the payments 20% of your income. That's just insane. I did that. Did an episode where I talked about my biggest mistakes in my 25 years, and that was one of them. It was driving a car that was way too expensive just to impress people that didn't care.
Okay, what kind of car was it? You got to
So,
tell me.
and then the housing stuff, I bought a BMW 5 years into being an advisor and thought it was like, it was the car payment was, I wouldn't even buy that car, have that car payment right now. It was insane. Um, I thought that I needed to look more successful. And actually, my clients didn't like it. They didn't like the fact that I had a nice car. They thought I was paid. They thought they were paying me too much. So it actually worked out, negatively towards not just me, but like for clients' perception and whatnot. So I, get that whole like ego, set that aside, drive a car that's affordable. It's, the when you buy a car, the fun feeling of owning it wears off in 90 days anyway. Yeah, obviously the housing is a tough one, but if you have a spare room, do some house hacking, rent it out. Um, if you're in a home that's too expensive and you can't move, that's a tough one. But wait for interest rates to come down. Maybe you locked in at 6.5, 7%, refinance that, but don't just refinance because your mortgage guy says you can do it. Wait till rates are more reasonable. But you can save a ton of money by refinancing from 7% to 5%. Extend that out. And then once you get back on track and you're saving again, then you're not worried about going into debt again or creating credit card debt. Because that's the biggest thing. They said that the average person can't come up with $500 for an emergency. So this for first step really should be get an emergency account. Forget about the 6 months of expenses that everyone says you should have. Like just get 2,000 in a high yield savings account and just have something there. Focus on that so that you have something to fall back on if you have an emergency rather than going into debt.
Yeah, my emergency was a rusted out water heater, but it was like $600. But the good part is that I had an emergency fund in place, so it wasn't something catastrophic, right? So that was, again, it wasn't 6 months of expenses, but it was enough to cover the emergency.
Right. Exactly.
I know the rules have changed, right? The old playbook that our parents had, right, is not the same. I guess as we kind of wrap up today, what are some like the big takeaway you want someone if they feel like they're going down this vortex, right? They're stuck in the middle class trap. What's that first step they can do? Is it just a mindset shift that I can get out of this?
Yeah, I think you have to stop having a scarcity mindset and have more of an abundance mindset. Instead of saying I only make enough to get by, figure out a way to get by with less or make some side hustle income so that you're not always thinking that. We all have the ability to figure out how to save more and to live a richer life. We just sometimes get lazy with things, or we don't have the energy to do it because we're stressed out. Take care of your health so that you're not stressed out. Do some meditating, do some journaling, do something to get yourself in the right frame of mind. Reading self-development books has helped me a ton over the years. It's what inspired my book and what inspired me to actually write a book. Like, I never thought it was possible because I did do well in English class back at high school. So, but I did it, and you can do anything you set your mind to. And I think you got to start somewhere. So the first step would just be to log into your 401k, make sure you're getting your employer match. Are you contributing enough to get your full match? If not, increase that contribution, and then increase it by 1% every single year. Step 2 is to set up one automatic transfer from checking to a Roth IRA or brokerage account. And I don't care if it's $50, automate it, make it invisible, create the habit, and then build upon that. And then just step 3 maybe is just go look through and just cancel one subscription. Start there. And then from there, look through the rest of them and do an audit. And then digging deeper, get on the horn and get 3 quotes for your homeowner's insurance, your car insurance. You're going to be able to save potentially a lot of money.
That's awesome. Awesome. Brian, this was super awesome. And for those of you that may be, at the gym or driving, I'm going to put those steps in the show notes so you can come back and let's dive in and do those. I love that challenge. I think it's great. And those of you that also are listening, if you didn't catch the previous episode, go listen to that. I had Roxanne on from Finance Rocks, who is a certified habit coach. So you can listen to her advice with Brian's advice, put them together and start taking the world by storm, man. That's awesome.
Nice.
Brian, before I let you go, let people know where they can find more about you and if they want to reach out to you and get some help.
Yeah, I have my channel on YouTube is Wealth Decisions by Brian, and you can go to my website, momentouswealthadvisors.com, and I have all the podcast episodes, and I have a lot of blog stuff, a lot of blog posts on a lot of these topics. And you can get a lot of information on any website. You have great resources, Chris. I love all the stuff that you've put out there. The tools are available. Our parents didn't have YouTube. They didn't have all this stuff to be able to figure out how to create a better life. And so the wisdom of the world is available, right?
I love it.
You just got to take some time.
That's awesome. Well, thanks again, Brian. I really appreciate your time. Thank you, everyone, for watching and listening wherever you get your podcast. Please like, subscribe, and share with others. And we'll see you next time on the Extreme Personal Finance Show. See ya.